Welcome to this comprehensive exploration of the governance of risk management from the Chapter 3 of Book 1, FRM GARP Foundations of Risk Management. Over the next session, we will examine how boards, risk management committee, and risk officers work together to translate risk strategy into operational reality. We will look at why governance failed in the financial crisis, how regulators responded, and most importantly, how we can play our role to defend our respective institutions. This is not about compliance boxes, it's about building frameworks that actually contain behavior, detect problems early, and keep our institutions safe and sound. Let's begin. Financial crisis of 2008 revealed something uncomfortable. The crisis wasn't fundamentally a failure of risk models or mathematics, it was a failure of governance. Boards approved complex strategies such as subprime mortgage products, exotic funding structures, massive leverage positions, without truly understanding the tail risks embedded in those decisions. And even though risk management functions existed on paper, they lacked real stature, meaningful escalation power, or influence over revenue generating decisions. Here is the critical insight. Weak governance turns risk dashboards into mere documentation. Strong governance converts risk measurement into actual decisions that change behavior. When governance fails, concentrations build quietly, incentive structures distort judgment, warning signals get rationalized away, and when market stress or liquidity pressure arrives, all those weaknesses reinforce each other catastrophically. That is why governance matters. It is the difference between information and action. Regulatory response to the crisis came in successive waves, each layer adding new governance demands. SOX started the conversation back in the 2000s, requiring clear accountability for disclosure, management, certification of controls, and independent audit. It established the principle that governance begins with reliable information. Then came Dodd-Frank and Basel III, which took a fundamentally different approach. They asked, what if we don't just fix information quality? What if we also restrict the activities that could threaten the system? Dodd-Frank created living wills and derivative clearing systems and requirements. Basel III tightened capital standards and added stress testing. Meanwhile, in Europe, the EBA, or European Banking Authority, and Single Supervisory Mechanism Frameworks (SSM) went even further. They started governance quality itself as a supervisory object. It wasn't enough to have risk committees. Regulators would now assess whether those committees were actually effective. And the Volcker role restricted proprietary trading and forced banks to redesign their organizational structures. Basel III represents a paradigm shift in what boards must understand and oversee. Pre-crisis, the board conversation was essentially about profitability and growth targets. Are we making money? Are we growing the business? Basel III changed that entirely. Now boards must simultaneously grasp multiple interconnected dimensions. First, capital usability. Not just the quantity of capital, but whether that capital is actually usable under stress. A bank might have a 12% capital ratio, but if most of that capital is in illiquid or hard to value assets, it won't help when liquidity pressure arrives. Second, liquidity resilience. Can we fund ourselves under stress? What happens when deposit runs occur or market funding dries up? Third, business model sustainability. Is our strategy sustainable under the regulatory requirements and market conditions we will face? Fourth, contagion channels. How interconnected are we with other institutions? What happens if a key counterparty fails? And fifth, organizational design for resolvability. If this bank fails tomorrow, can regulators unwind it without systematic damage? Boards that still think governance is primarily about returns and growth are fundamentally behind the curve. Post-crisis governance framework addresses 5 distinct but interconnected concerns, and understanding each one is essential to building effective governance. First, stakeholder priority. Banking is different from ordinary corporations. Banks hold deposits that are government insured, they access central bank liquidity, they operate within a financial system where their failure creates externalities that affect everyone. That means shareholders aren't the only constituency that matters. Board must govern within the attention to depositors, creditors, and systemic stability. Second, board composition. A board with excellent business experience but no banking or risk expertise cannot effectively challenge complex risk decisions. When a CRO presents a stress scenario showing potential losses in a complex derivatives portfolio, the board needs members who can understand what they are being told, not just trust what it is being handled correctly. Third, risk oversight. Risk is often diffuse in large organizations. Credit risk lives in the commercial lending group. Market risk lives in trading. Operational risk is everywhere. Without explicit authority, clear information flows, and named accountability, these risks don't aggregate into a coherent picture. Boards need structural mechanisms to ensure risk visibility. Fourth, risk appetite. When the board merely states that it values prudent risk-taking, that's not governance, it's marketing language. Real appetite statements need to be specific enough to constrain behavior. And fifth, compensation. This deserves its own deep dive, which we will do next. We covered the first 3 concerns. Let me focus now on risk oversight and risk appetite in more detail. Risk oversight starts with a simple principle. Diffuse responsibility is no responsibility. In a large universal bank, multiple business units take risk. Without a clear governance structure that names who owns what decision, who challenges it independently, and who monitors compliance, risk just accumulates. The Board Risk Committee, working with CRO, is the governance body that aggregates these scattered risks into a coherent risk picture. They ask questions like, are we inside appetite or concentrations building in ways that connect to each other? Are we taking the same risk multiple times through different business lines? Risk appetite is where strategy meets constraint. It's not just a target, it's a boundary. The board approved appetite statements tells the organization, this is the level of risk we are willing to take to achieve our strategic objectives. And this is what we will absolutely not do because it threatens franchise value or stability. When appetite is vague, for example, we are committed to prudent risk taking, it constrains nothing. But when it is specific, like we will not exceed a 15% maximum loss in any single counterparty under 2008 equivalent stress scenario, it creates a real boundary that constrains decision. And here is the key. Boundary statements only work if they are tied to actual limits, escalation procedures, and consequences for breach. Compensation deserves focused attention because it can either reinforce governance or systematically undermine it. In the years before the financial crisis, compensation structures created a profound asymmetry. Senior traders could earn multi-million-dollar bonuses in good years based on short-term revenue generation. But when those positions deteriorated into losses 3 or 4 years later, the risk taker was already gone, often to another institution, with their gains already spent. This structure created perverse incentives. If you originate a mortgage-backed security that generates $10 million in year 1 revenue and $13 million losses in year 3, the year 1 risk taker made their millions, received their promotion, and left the firm. The losses landed on someone else's books and the shareholders' balance sheet. Post-crisis reform tried to fix this through deferred compensation. If 50% of your bonus is held for 3 years and subject to clawback, If the business loses money, your incentive structure changes dramatically. You now have to think about whether that revenue is truly sustainable. But here is the reality. Deferred compensation is complex to administer and is increasingly challenged by employment lawyers. The real solution is simple and harder. You have to align what people are measured and promoted on with sustainable risk-adjusted outcomes. If your trader is rewarded for volume and spread income without attention to concentration risk or model assumption risk, you will get concentration risk and model assumption risk, no matter what your policies say. Governance cannot succeed when compensation contradicts it. Translating governance principles into an operating blueprint for a strong banking institution is vital. The core message is that governance should not remain a set of abstract principles on paper. In a well-governed bank, these principles must be visible in the way the institution is structured, managed, challenged, monitored, and supervised on a day-to-day basis. Let me walk through the main principle clusters. First, board and board composition. A strong bank should have a board with a clear mandate, the right technical expertise, sufficient independence of judgment, and enough diversity of perspective to challenge management effectively. In addition, board members must have the time and capacity to oversee the bank's risk profile, strategy, and control framework in a serious and informed way. Second, senior management and group structures. Governance does not stop at the board level. Senior management must translate board strategy into execution through clear mandates, documented responsibilities, and consistent accountability across the group. This is especially important in complex banking groups where legal entity structures, business lines, and control responsibilities can otherwise become fragmented or unclear. Third, the risk management function and the CRO. A strong bank should be able to demonstrate that risk management function is independent, properly resourced, and capable of providing effective challenge. The chief risk officer should have direct access to the board and relevant committees, strong escalation rights, and the analytical capacity to aggregate risks across the institution. This is essential for ensuring that risk issues are not diluted, delayed, or overridden by short-term commercial pressures. Fourth, monitoring and communication. Good governance depends on timely, accurate, and decision-useful information. A strong bank should have robust monitoring systems, effective limit reporting, transparent escalation of breaches, and coordinated communication across risk, finance, compliance, and the business. Without this information flow, even well-designed governance structures can fail in practice. Fifth, compliance and internal audit. These functions provide independent assurance that the bank's control environment is working as intended. A strong institution should be able to show that compliance oversees adherence to laws, regulations, and internal policies, while internal audit tests the effectiveness of governance processes, controls, and risk management arrangements. Their independence is critical to institutional credibility. Finally, compensation, disclosure, and supervisors. Governance must also extend to incentives and transparency. Compensation structure should be risk sensitive and should not reward excessive short-term risk-taking. Disclosure should be sufficiently clear to support market discipline, and the overall governance framework should be robust enough to withstand regulatory and supervisory scrutiny. So, taken together, this slide shows that sound governance in banking is not a single policy or committee. It is an integrated system. It links leadership, accountability, independent control, information flow, assurance, incentives, and external oversight into one coherent operating model. For bank risk managers, the implication is clear. Governance quality must be assessed not only by formal structure, but also by whether these principles are genuinely functioning in practice. This is a critical evolution in how we think about board duty and banks. In ordinary corporations, the board's fiduciary duty runs to shareholders. Directors owe shareholders the duty to maximize long-term enterprise value, but shareholders are the owner and the ultimate beneficiaries. Banking is different, and the law and regulation reflect that. A bank's board fiduciary duty extends beyond shareholders to the institution's safety and soundness. Why? Because depositors depend on that institution. Creditors depend on it. The payment system depends on it. And if a large bank fails due to excessive risk-taking by its board and management, taxpayers often end up absorbing losses. That broader duty means the board cannot simply ask, will this strategy maximize shareholder returns? They must ask, will this strategy create concentrations we can't manage? Will it strain our liquidity under stress? Will it expose us to tail risk that threatens the franchise? This creates tension sometimes. A board might see an opportunity that could generate significant profits but requires taking on concentration or leverage that feels uncomfortable. The fiduciary duty to the institution says, protect franchise value and soundness first, profits second. That's not a constraint on legitimate risk-taking. It's a reordering of priorities that reflects banking systemic role and the economy. Risk appetite is where most governance frameworks fail in practice. Boards approve appetite statements that sound reasonable in a meeting room but never actually influence decisions. A meaningful risk appetite statement needs to do several things simultaneously. First, it needs to align risk-taking with mission and strategy. If we are a regional community bank, our appetite for complex derivatives trading should be different from a global, systematically important institution. Second, it needs to preserve accountability. It cannot be so vague that no one can be held accountable when it's violated. Third, it needs to maintain a prudent attitude toward tail risk. This is the hard part. It's easy to have an appetite for normal outcomes. The discipline is having an appetite statement that constrains behavior when markets are stressed and tail risks are moving from theoretical to real. Fourth, it needs to balance risk and return sensibly. We are not running a charity. We need to generate profits and capital. The appetite should reflect that. Fifth, it needs to meet regulatory expectations. Supervisors will review your appetite statement. They will ask whether it's credible, measurable, and actually constrains decisions. And sixth, it needs to enable monitoring and reporting. If you can't measure it and report against it, it's not an appetite, it's just poetry. Here is how appetite becomes real. It gets translated into specific policies for each major risk type: credit, market, operational, liquidity, and others, and so on. Each policy creates limits, indicators, and escalation procedures. Those limits get monitored continuously. Breaches get escalated and reported, and the board gets periodic reports on whether the institution is operating inside its approved appetite. That's the journey from statement to operating system. Capacity, appetite, tolerance, and performance. These four terms often get confused, but they mean very different things in governance context, and understanding the distinction is essential. Capacity is the outer boundary, the maximum amount of loss an institution could absorb before it becomes technically insolvent. It's determined by capital, liquidity, and earnings. It's not a choice, it is a constraint. If your bank has $10 billion in capital and your risk models show a worst-case loss of $12 billion under a severe stress scenario, your capacity is exhausted. Appetite is what the board chooses to do inside that capacity boundary. The board might say, even though we could theoretically lose up to $12 billion in stress, we are going to manage the business so that our maximum loss is $5 billion. That $5 billion is our risk appetite. Tolerance is the acceptable variability around normal performance. If we set a target for credit losses of $500 million per year, tolerance might be 400 to 600 million. Within that range, it is normal business. Outside that range, it is governance event that needs investigation and escalation. Performance is simply what actually happens. It is the realized loss, the realized volatility, and realized concentration. Over time, if performance stays inside tolerance, inside appetite, and inside capacity, you are managing the business well. The pedagogical power of this framework is that it distinguishes hard constraints, such as capacity, from strategic choices like appetite, from normal variability like tolerance, and from outcomes like performance. Understanding which helps managers know how governance mechanisms to trigger when problem arises. The board has two primary risk oversight committees, and they serve fundamentally different purposes. The audit committee is backward looking. It asks, did we do what we said we would do? Are our controls working? Is our reporting accurate? Have we followed our policies? The audit committee oversees internal audit, reviews integrity of financial statements, and assesses the effectiveness of internal controls. It needs financial literacy. That's members who can understand complex accounting, especially for financial instruments and complex exposures. The audit committee also needs independence. It should feel comfortable challenging management without fear of retribution. And it needs time. Good audit committee work cannot be done in a 2-hour annual meeting. The key question for an audit committee are controls reliable? Is financial reporting accurate? Have policies been followed consistently? And has independent assurance been obtained on the control environment? When an audit committee does this work well, it provides a crucial backstop. It catches errors before they become scandals. It detects policy violations before they become regulatory violations, and it protects the board from surprises. When an audit committee is ineffective, perhaps because it lacks financial expertise or feels pressured by management, problems fester invisibly until they become larger and public. The risk committee, by contrast, is forward-looking. It asks, are we inside our approved appetite? Are new risks emerging? Are concentrations building? Are the risks we are taking today going to hurt us tomorrow? The risk committee reviews the bank's overall risk profile, typically presented through a comprehensive risk dashboard that aggregates credit, market, operational, liquidity, and strategic risks. It reviews major risk policies and limits. It monitors whether business strategy remains consistent with the risk appetite. Crucially, the risk committee is supposed to be the forum where emerging or material risk issues get surfaced and debated at the appropriate level before they become crises. If the chief risk officer sees credit concentrations building in a particular sector, or if market stress tests show unusual vulnerability to a specific scenario, the risk committee is the first place where those issues get board level attention. The risk committee's key questions are different from audits. Risk committee asks, are we inside appetite? Are concentrations building in ways that could compound? Are limits appropriate for our current strategy? Are emerging risks being flagged early enough? Compare the two. Audit asks, did we comply with policy? Risk asks, is our policy still appropriate? Audit looks backward, risk looks forward. Both are essential. A board that only has an audit committee is relying entirely on backward-looking assurance. A board that only has a risk committee is missing the mechanisms to ensure that policies and controls are actually working. The Chief Risk Officer occupies a unique and structurally difficult position. The CRO sits between strategy and execution, between business lines and control functions, between management and the board. The CRO's core responsibilities include designing the risk framework that translates the board's appetite into operational policies and limits, coordinating the aggregation and reporting of risk information across the entire institution, challenging business assumptions and proposals with independent risk perspective, and escalating material issues to senior management and the board when they breach appetite or threaten the control environment. Independence is essential. If the CRO reports to the CFO or Chief Financial Officer or the Chief Operating Officer, there is a structural conflict of interest. When the business is under pressure to hit revenue targets, those executives will prefer that difficult risk conversations stay quiet. A CRO who depends on them for budget and career advancement will face enormous pressure to accommodate that preference. But independence alone isn't enough. The CRO also needs connectivity. The CRO must understand the data, the valuation methodologies, the business line strategies, and the treasury operations intimately. A CRO who is independent but disconnected from operational reality is ineffective. They are just issuing edicts that don't reflect business realities. Governance failures often appear first not as explicit policy violations, but as broken connections between the CRO, business lines, finance, and treasury. Information doesn't flow properly, decisions get made without proper risk input, and the system operates in silos rather than as an integrated whole. That's why the CRO's interdependence with other key functions is not a weakness, but it is an essential architecture in any banking organization. Limit framework is where risk appetite becomes operational reality. It's the primary mechanism through which the board's strategic intent gets translated into day-to-day decision rules that constrain behavior. A well-designed limit framework has several characteristics. First, limits are derived from appetite and calibrated to actual business models and products. You don't just set a 5% loss tolerance across the board. You recognize that credit losses in commercial lending behave differently from trading losses from interest rate volatility. Each risk type needs limits appropriate to its nature. Second, limits operate at multiple levels of granularity. You might have a broad constraint. We will not lose more than 15% of capital in any single stress scenario. But you also have granular limits. Individual traders have position limits, sectors have concentration limits, counterparties have exposure limits, and so on. This multi-layered approach catches problems at various scales. Third, limits get monitored at appropriate frequency. Some limits need to be checked daily, a trader's value at risk limit, for instance. Other limits get checked weekly or monthly. Some limits like a region's concentration get reviewed quarterly or in stress testing. The frequency should reflect how quickly a breach could become problematic. Fourth, breach procedures need to be disciplined. When a limit is breached, there is a defined escalation process. A temporary increase might require approval from a risk committee. A persistent breach might require senior management and board attention. And breach data needs to be accumulated and reviewed to understand whether breaches are normal noise or signals of changing risk posture. Fifth, The organization needs to understand the difference between a limit breach, which is a governance event, and a normal variability within the limit, which is expected. That's where the tolerance discussion comes in. When limit frameworks have these characteristics, they actually constrain behavior. When they lack them, limits become decorative. They exist on paper, but everyone knows they can be waived or reinterpreted. Internal audit completes the governance system by providing independent assurance that the framework actually works in practice. Here is a key insight. Governance can decay silently. Committees can continue to meet, risk reports can still be produced, appetite statements can still exist on paper, but the underlying control environment can be quietly weakening. Controls might deteriorate because staff turnover reduces expertise. Data quality can decay if data governance gets deprioritized. Model governance processes might be weakened because business pressure makes exceptions seem reasonable. Escalation procedures might be bypassed informally because everyone knows this is an exception. From the outside, everything looks fine. The governance architecture is still in place, but it's become ceremonial rather than substantive. Internal audit's role is to test whether governance has operating substance. Audit reviews the adequacy of controls by actually testing them, not just reading the documentation, but walking through the process to see if it actually works as designed. Audit reviews risk processes to understand if they are producing information that actually influences decisions. Audit assesses policy compliance by looking for systematic deviations or exceptions that have become accepted practice. Audit also reviews governance routines themselves. Do risk committees actually review emerging risks or just existing exposures? Does the board risk committee meeting influence decisions or just document what is already been decided? Does the CRO actually have the ability to escalate issues, or does business pressure prevent it? A strong internal audit function protects the organization by detecting governance decay early. A weak internal audit function allows the decay to continue invisibly until it contributes to losses or regulatory failures. Let me conclude with a key insight. Effective governance of risk management is fundamentally a system-wide phenomenon. You need strong board oversight, a board that understands risk and allocates time to it. You need a credible risk appetite, an appetite statement that is specific enough to constrain behavior. You need robust committee design, clear delineation between the risk committee's forward-looking role and the audit committee's backward-looking assurance role. You need an authoritative CRO, someone with independence and stature. You need transparent limits and escalation procedures. You need incentives aligned with prudent risk-taking, and you need rigorous internal audit. None of these elements works well in isolation. Strong board oversight with a weak CRO fails. Excellent committee design with misaligned incentives fail. Detailed policies and limits with inadequate audit assurance fails. But when these elements reinforce each other, when they are designed around a coherent governance model, something powerful happens. The organization develops a governance architecture that actually constrains behavior, detects problems early, and protects the institution. And that is the goal. Not governance for the governance's sake, not compliance boxes checked on a spreadsheet, but a governance framework that works, that actually keeps your institution safe and sound, that allows prudent risk-taking within clear boundaries, and that gives your board, your senior management, and your supervisors confidence that risks are being managed thoughtfully. Thank you for your attention.